The RBA is being warned to proceed with caution.
Announce a sixth consecutive rate hike.
At some point we need to pause for breath and reassess.
It's a delicate balance.
100% it is, and that's why.
Now, just because this is a bit less than what many people were anticipating, and just because it's consistent with what we're seeing around the world, won't make it that much easier for Australians to find room in their household budgets to meet the increasing costs of servicing the mortgage.
Even before today's interest rate hike, Australian house prices were recording their sharpest dive ever. Just one reason why the Reserve Bank may have raised rates today by just 25 basis points instead of the 50 basis points that the markets had been expecting. RBA Governor Phil Lowe noted a couple of other reasons to take a more measured approach: the deteriorating outlook for the global economy and how household spending is being hit by interest rate rises to date.
The board's priority is to return inflation to the 2 to 3% range over time. It is seeking to do this while keeping the economy on an even keel. The path to achieving this balance is a narrow one and is clouded in uncertainty.
The impact of rate rises on borrowers is usually the headline story in any Reserve Bank rate rise, but Treasurer Jim Chalmers had a much bigger message to deliver today in the wake of the RBA's move.
The storm clouds are gathering in the global economy, and that's not irrelevant to us as we finalise the budget.
Jim Chalmers will hand down his first budget in just 3 weeks' time. The first budget of a new government is always a crucial marker for setting its agenda and delivering on election promises. But the budgetary aftermath of pandemic spending, energy price shocks, rising interest rates and inflation around the world, and now the probable likelihood of recession makes for an even tougher task than usual.
The household is one of the key uncertainties that the Reserve Bank is grappling with. We've got a household that is carrying large amounts of debt and facing one of the most rapid rate hike cycles we've ever seen. But on the other hand, we've got unemployment that is at multi-decade lows, job security that is very, very high, and a large amount of savings built up during the pandemic.
The broader question is, will the rate rises to date tip the economy into recession?
As the Reserve Bank is getting back to some sense of normal in terms of the interest rate environment, the risks start to grow. The risks grow that they will overshoot.
Right around the world, central banks have a really difficult task at the moment. We're seeing quite divergence around a willingness to push economies into recession. In the US, for example, the central bank seems relatively comfortable that that is what they may need to do, or that is what they are willing to do. Here in Australia, there seems to be a little bit more focus on that narrow path to the soft landing.
As he prepares his first budget, Australia's Treasurer has ramped up the warnings about the possibility of recession.
The likelihood of recession has tipped over from possible to probable in some of these big economies, which are very important to us.
What the Treasurer has been particularly emphasising in recent days is what has happened in the UK in the last couple of weeks. The phrase, a cautionary tale, started to turn up last week.
You do need to make sure that you've got fiscal and monetary policy working together. The fact that that's not currently the case in the United Kingdom, I think, is a cautionary tale about the possible costs and consequences of not striking the right balance there. And so we're obviously conscious of that.
That cautionary tale refers to the debacle of the mini-budget handed down by the new UK Chancellor of the Exchequer 2 weeks ago. It was designed to fuel growth with big tax cuts, even as rate rises were trying to slow it down. Just 24 hours ago, the Chancellor was forced to perform a spectacular and humiliating backflip on part of his plan, dumping big tax cuts for high-income earners.
I know the plan put forward only 10 days ago has caused a little turbulence. I get it. We are listening and have listened.
The specific cautionary tale for the looming Australian budget out of the UK experience relates to the so-called Stage 3 tax cuts for high-income earners, worth $70 billion, which are due to start in 2024. With the budget forecast to remain in deficit for the next 4 years, those tax cuts are effectively unfunded, as were the tax cuts in the UK that the Truss government was humiliatingly forced to abandon. Jim Chalmers has been shifting the emphasis of his language on the tax cuts, particularly in the last few days.
As we do finalise the budget, we will put a premium on what's responsible, what's affordable, what's sustainable, and what is sufficiently targeted to deal with the economic cards that we have been dealt.
There's a lot of code and smoke signals to unpack here. Until today, the Treasurer has repeatedly stated that the tax cuts would go ahead because Labor had promised to honour them. It was notable today that he did not repeat that line until explicitly pressed, and then only with a significant proviso.
We haven't altered our position. I mean, obviously any responsible government looks for ways to make the budget as sustainable and responsible as it can.
In tough budgetary times, with pressure to fund health, aged care, the NDIS and a burgeoning government debt bill, a $70 billion tax cut to high-income earners doesn't really seem to meet most of those criteria.
Now, the stage 3 tax cuts were legislated a couple of years ago and are still a couple of years off from coming in. This is an important time for the government to think about what the purpose of these tax cuts are. And it's not a case of necessarily getting rid of them, but actually, how do you repurpose them to meet the needs of the economy?
Given the uncertainty that we're facing in the economy, it's pretty hard to make a clear-cut judgment at the moment. They do look to address bracket creep, which is important. They do look to simplify the tax system, which I think is welcome. But I guess we do have an opportunity to ask ourselves, for the cost, are they the best form, are they the most effective form of tax relief that we can do?